Chamath is one of the few people who has benefited from the tech boom. Chamath has invested in growing tech titans for the past 9 years, averaging a 33% annual return. However, Chamath has changed his mind. Chamath believes the whole stock market, particularly IT businesses, will be in turmoil during the next few years. He's come up with a new strategy that he thinks will outperform the market. Chamath's macroeconomic perspective and how he is maneuvering his assets to safeguard his portfolio will be discussed in depth in this video. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is released. So if you're ready, let's get to it. Consumer demand is recovering, but supply networks around the world are struggling to keep up. Despite the fact the economy is improving, many people are refusing to return to work. Over the last year, the number of non-farm employment vacancies has risen dramatically. Non-farm job vacancies are the total number of employment available to all employees, excluding farmers. Many investors and economists believe that the supply chain problems are only temporary. Chairman of the Federal Reserve, Jerome Powell, believes that salaries are not rising at an exorbitant rate. The employment cost index is only increasing at about 3% per year, according to Powell's inflation dashboard, which is not much compared to the rate of increase in the 90s and 2000s. Cathie Wood has also declared publicly that cyclical deflation is on the way. Corporate executives agree, with AMD CEO Lisa Su predicting that the chip shortfall will end next year. Chamath is adamantly opposed to everyone, because he believes that supply chain concerns will persist and that inflation is on the verge of exploding.
I think that most people are under the impression that these are short-term kind of contractions and expansions, and that this is just a thing that needs to get worked through the system as we readjust to a post-COVID world, blah, blah, blah. I think it's different. And the reason I think it's different is if you just look at one thing and one thing only, which is that we have a massive labor shortage in America. And there's an incredible stat that I saw, which was the average hourly earnings of non-manager people in hospitality and travel. And the average salary, the mean salary was around 20 some odd dollars an hour, and it's now $33 an hour. And so what that to me says is that we are going through a really sustained period where you cannot get people to do the work that needs to get done.
While I couldn't discover the specific number that Chamath was looking for, it is undeniable that pay for leisure and hospitality workers are skyrocketing. Over the last 12 months, the average hourly wage for employees in leisure and hospitality has risen from $16.85 to $18.58. Increased wages sounds nice, but the Consumer Price Index shows that wage growth and supply chain difficulties have also been boosting consumer prices by a similar percentage. Despite the Fed's projections, consumer prices have continued to rise at a breakneck pace. This resulted not just from a manpower scarcity, but also from rising raw material prices. Both of these variables, Chamath believes, will keep inflation stable in the short to medium term.
There's people, right? So labor capital, I just think it's getting more and more expensive to get folks to do work. And then there's the raw materials that you use to make anything. And everything that I see is that stuff is going bananas. And so I put these two things together and I'm like, I think this stuff is here to stay. I'm really kind of a little bit of a, and I had not worried. And you can see in every episode before this, I was always consistently like, there is no inflation. You can fade the inflation trade. And now I'm kind of positioning myself to hedge myself in this situation.
The Federal Reserve, as we discussed previously in this video, is sure that inflation is only temporary. The great majority of Fed employees believe interest rates will not be raised until 2023. The European Central Bank similarly does not intend to hike rates, stating that they will not do so until 2023. On the surface, this appears to be good, but other countries are not on the same page. Many other nations are seeing much greater inflation rates, which could affect the dollar and euro. Because of rising inflation, central banks outside of the United States and Europe are starting to hike interest rates, potentially causing severe problems in the global economy.
Central bankers around the world have raised rates. The only place that hasn't gone up is Europe, ECB, and the United States, the Federal Reserve. So, and let's be honest, Europe and the United States, we absorb labor and materials from all around the world, right? We are the net importers. We are the net ultimate buyers of last resort of all of these things. And so if you're seeing inflation in those other, supply-driven economies, they are going to come on shore. They're going to hit us in the face. I think prices are going up.
Chamath predicts the US economy will face stagflation, which occurs when inflation and unemployment are both high at the same time. Stagflation means the economy will suffer as prices continue to rise. For central banks like the Federal Reserve, a stagflationary moment is the worst since any decision has disastrous implications. For example, if the Federal Reserve raises interest rates, the economy will collapse. However, if the Fed maintains its low interest rate policy, inflation will grow even further. Stagflation is one of the worst circumstances to be in, which is why Chamath is planning for it as soon as possible. This isn't the first time that this has happened, and it might happen again. President Lyndon B. Johnson spent a lot of money on the Great Society and the Vietnam War in the 1970s. Following Richard Nixon's inauguration, he inherited a recession and spent heavily, causing inflation to approach double digits. In the late 1970s and early 1980s, the new Federal Reserve Chairman, Paul Volcker, raised interest rates at the expense of the economy, eventually bringing inflation under control. Inflation and unemployment were at an all-time high throughout the 1970s, as this graph shows, and GDP growth could not just keep up. Chamath believes that we will have stagflation similar to the 1970s.
I think the labor shortage is going to get worse, not better. I think we're going to have to pay people more to get out of it. I think prices are going up. Input costs are going up. Energy costs are going up. So this is it. I think that probably the Fed and the ECB are really raising. This time next year, they're probably in a really tighter posture. I don't think it's a short-term blip. And I think that we are in a period that will resemble the late 70s.
We now know that stagflation is a possibility. But what can investors do to protect themselves? First and foremost, we must address the subject of what not to do. In an inflationary climate, unprofitable tech firms would likely see their losses grow even faster during periods of inflation. Businesses that are already profitable, on the other hand, will be able to expand their earnings as a result of price increases. During periods of rising inflation, Chamath feels that three characteristics in particular are worth looking for.
I'm very concerned about medium-term inflation. And so in an inflationary environment, in my very simplistic view of the world, I want to own three things. Hypergrowth, because hypergrowth can always outrun inflation. Think of that as like companies that are growing 50+% a year. It's incredible growth, right? Then I want to own cash generative assets. Think of that as like, a great example is like a mining stock. I know that sounds crazy, but it's pretty incredible. And then I want to own non-correlated assets. Bitcoin, Solana, DeSo, a lot of the DeFi protocols, because it's a great counterintuitive hedge against all of this stuff.
Chamath is investing in hyper-growth businesses, cash-flowing generating assets, and cryptocurrencies. While I agree with Chamath on the last two types, cash flow generating assets and cryptocurrencies, the first group of equities, hypergrowth firms, has some big faults. High inflation would be harmful to hypergrowth stocks because investors would now want cash rather than future cash flow growth. This is due to the fact that in an inflationary climate, future cash is worth significantly less than current cash. The way numbers multiply is another reason why hypergrowth would not perform well in inflation. If a high rate of revenue growth is discounted by a high rate of interest, the growth rate will not compound as quickly, resulting in lower valuations. Cathie Wood's former employer, AllianceBernstein, describes this concept. I own high-growth stocks in my portfolio, but I continue to believe that such assets will be unaffected by inflation. The reasons I just described are very close to Chamath's own thinking when he explained why tech stocks are likely to tank.
Tech stocks in the fucking toilet. No bueno for no cash flow growth stocks. Yeah. Thing with tech stocks is we tell everybody the same thing. Your money is going to come 30 years from now because we're going to be a monopoly by then. And every dollar that I have today, I'm going to reinvest into R&D and engineering. in an environment where interest rates are zero, you're happy to do it because you're like, well, great, these guys are investing at way better rates than zero, which is what I get from, my bank. And so I want Facebook and Google and Amazon and all these startups to be putting all this money in the ground on my behalf. But when interest rates start going up, they say, no, hold on a second. I need more money up front, less money in the future because the future becomes more uncertain. And that's the big trade-off for tech companies where they get really pummeled.
Chamath's forecast for medium-term inflation appears logical, and it resembles what Michael Burry feels. Cathie Wood, on the other hand, sees the polar opposite happening. So please tell me, who do you believe is right down below? And that ends today's video. If you haven't already, click the like button below to show your love and support. Also, don't forget to subscribe to the channel and clicking the notification bell right next to it to be the first to know when a new video is posted. Thank you for taking the time to watch, and we hope you had a great time. We hope to see you again soon.